My next guest says, get used to it. The trend's going to continue in 2011. Joining me now, Nicholas Colas, Chief Market Strategist at BNY ConvergEx Group. Nick, welcome back to Bloomberg. Always good to have you on.
Thanks so much.
Why should people get used to this?
Well, after 30-plus years of a tremendous bond market rally, I think we've finally reached the inflection point where bond yields are going to have to begin to rise. Rise because the Federal Reserve wants inflation back in the system, and rise because we have a structural deficit problem in the U.S. that's going to get more and more market attention, more and more bond market attention as the years go by.
You mentioned structural deficit. This is something that a lot of people may be tiptoeing around. That means this is endemic to the system. We just can't get our hands around it or choose not to.
I think we saw with the agreement last week between the President and the Congress, there's a real lack of political will to get our hands around it. And that's not going to change any time between now and the next presidential cycle. So we're going to face at least one more round of the federal limit on debt, which is currently $14.3 trillion, being raised at least once more, probably twice more before the next election comes around. That, I think, is going to put some concern into the bond market that we're going to face a European-style mini crisis of confidence in the dollar at some point in the next couple of years. Nothing so severe as to bring the system down, but investors will ask for higher interest rates.
Is that what we were seeing going on last week in the bond market?
I very much believe so. The bond market was really caught unawares by how aggressive this plan was. And I think the bond market realizes not only do we have an issue in raising more debt, but it also reduces the funding for Social Security.
Who are the monsters under the bed?
The monsters under the bed.
You wrote a paper, and that was one of the headlines, the monsters under the bed. Who or what are they?
The monsters under the bed are the handful of issues that really frighten investors. And the point of that piece was to point out that while there are many problems in the economy, it doesn't seem like any one is really going to whack us at any given time. I think we're going to have to address them slowly and structurally over a period of years. It's going to limit things like stock market returns, but we shouldn't look under the bed and be truly frightened of what we see. We've got to address it.
Okay, speaking of addressing it, quantitative easing 1, quantitative easing 2, as you know, a couple of weeks ago in 60 Minutes, Fed Chairman Ben Bernanke said if need be, there could be a quantitative easing 3. Is that what the Fed has left in its arsenal?
Pretty much, yes, because we're already at zero interest rates over the short term, and we'll see the Fed reconfirm those tomorrow with the Fed meeting. But the Federal Reserve is very aware of the fact that there's an overwhelming pressure in Washington to cut the deficits down, at least on the rhetoric basis. And so I think they stand ready to try to fill that gap if need be.
And Nick, if we could, guys, keep that up on the screen because we're taking a look at your 2011 predictions. First off, S&P will reach 1375, 10-year yield will move to plus 4.5%. What metrics are you using to get to those figures?
Well, for the S&P, we're looking at an earnings number just shy of $90 an S&P share, which on a normalized revenue and PE basis gets us to that S&P number. That seems fairly non-controversial. The more controversial part of the call is that interest rates are going to rise, I think, a little bit more than people are expecting. 4% is the top end of most folks' expected band. I think 4.5% is more likely given the layout that we have for particularly the issues on deficit and deficit reform next year.
Okay, you talk about persistently increasing interest rates, a profound change after 30 years of secular decline. Tell me exactly what you mean by that.
What I mean is that we've had a tremendous bull market in bonds, which has brought the interest rates down to the levels that we've seen them over the past year. That's been very beneficial for stock market valuations, for investment around the world. And at this point, we're going to, I think, begin to see those rates begin to reverse. That's going to take time to work through and have everybody from CFOs to investors think about what that means to their investment profile.
Speaking of CEOs, might I ask, tomorrow President Obama is scheduled to meet at the White House with a group of about 20 CEOs. Expecting anything to come out of that?
Probably not, but I think in private he's going to have an earful from these CEOs about what they really want to see from the second 2 years of his term as far as things that will actually create job growth, because we've had so little of it so far.
Are we going to see any improvement in the labor market in 2011?
I think very little. I think we're going to face an issue where there's structural unemployment. The people who are unemployed currently have skills in areas like the trades, building houses, or in the mortgage sector, where there's still not a lot of incremental demand, or in manufacturing, where these companies have gotten really efficient over the past couple of years.
And then on the flip side of that, no improvement in the labor market, in your opinion, but we're going to see good corporate earnings next year.
That's right. It's sort of that's the central conundrum. If you think about the last 18 months, we've seen corporate earnings growth rise pretty dramatically in a still very moribund economy with a slack labor market. For the folks who are spending, corporate America has figured out how to deliver goods and services to them in a very efficient way. And so corporate earnings seem, on a grand scheme of things, pretty much of a lock relative to the uncertainties we've been talking about here.
All right, Nicholas Colas, ConvergEx. Always good to have you on. Thanks so much.
Good
to see you again, too.